Welcome back to Money Media, and today we're going to be discussing silver at its all-time high prices and why, because of this all-time price, that we may see ripples throughout the global economy because of what is driving these all-time high prices. So stick around. All right, so today I've got a massive one for you. It's discussing the price of silver, whether you're close to the situation or you're not. Even if you're not, you probably even accidentally heard about how high silver and the rest of the precious metals markets have gone in the last 12 months. There's not much chatter about what's actually driving it. And so I wanted to cover that. The reason why I wanted to cover that is because it's really important and it may come to affect everybody globally through some of the institutions involved. And so it's really important to know and understand for your economic journey. So without further ado, let's get stuck in. Some of the largest holders of silver globally are actually large banking institutions. The reason for that is because they act as a conduit, meaning they supply a lot of the market, whether that be institutional investors or simply just retail investors. They supply a lot of the physical silver. And so because of that, it's a requirement for them to have large physical stockpiles of silver on hand. It makes a lot of sense. What large institutional banks have been doing in the last 6 to 12 months, some even longer, is because they own such a significant store of silver specifically, because in terms of gold, central banks own a lot more gold in terms of ratio to large banking institutions. So they're not able to control the price of gold as much as they are able to control the price of silver because they own a lot more, because the supply of silver globally is a lot less and therefore a lot easier to manipulate. And so what banks have been doing for the last 6, 12 plus months is taking out short positions against the price of gold in a form of derivative. Now, and I want to cover those two things. So short selling anything, short selling silver, means that you're betting for the price to go down. Usually when you buy a stock, you are assuming that that stock will go up in value and therefore the difference in the buy price and the sell price will return you a profit, and that's your investment. Whereas a short sell is backwards. It means that the short seller is betting on the price of that asset to go down, which the banks are doing. Now, when you add that as a derivative, it means they're able to lever their short selling position. Now, leverage, which we've covered in the past, the best example of it that I explain is a home loan, where if you've got a 10% deposit on a $100,000 house, then you've got $10,000 as a deposit. That's levered 10 to 1. These banks are taking out short selling positions which are levered quite significant as well, because they are super confident that the price of silver will go down. Why are they confident that the price of silver will go down? Well, it's because they have such significant stores of physical silver that they have a level of control over the price. And so if they are not convinced that the silver is going down, trending down in the manner that they would like to be able to gain a profit off their investments, then they can release excess amounts of silver onto the market. Now, when there's excess supply, it tends to reduce the price. And so what they haven't factored in is that silver has obviously large commercial value in application. So whether that be in catalytic converters, it's used in a lot of AI applications, it's used in all of the data center manufacturing, which is being created globally for the AI demand, and it's being used in a lot of our solar panels, technology, etc., etc. And so the commercial demand for silver is quite high. Now, not only that, but you add into that mix that during all around the world, currencies are looking quite risky at the moment, with a lot of them being devalued. And so people, retail investors and institutions, are moving much more heavily into precious metals to hedge their risk against holding a certain country's currency. So all those factors in play are meaning that the banks aren't able to reduce the cost of silver, because as much silver as they're releasing to the market, the demand is picking up that silver and is still in short supply. And so that is continuing to push silver prices up and up and up, which is draining the global supply of silver. Why is this important? It's important because the banks aren't able to recover any profits on their short selling. Not only that, but they leave it at significant levels. So what this means is, in an already shaking global banking institution, if these guys aren't able to collect their large bets that they've made on the price of silver going down as it continues to go up, it means they're going to owe vast sums of money. And you may have noticed that banking stocks are actually continuing to fall. And that's because they've got too much risk on their balance sheet. In an extreme example, but one that I'm actually entertaining for 2026, we're currently in early January 2026, what we could see from this in certain countries whose banking institutions have gone too heavily into some of these leveraged silver short selling positions is we may actually see many bail-ins. Now, we've covered bail-ins in the past with Money Media, but what a bail-in is essentially the bank that holds your money disallows you to withdraw any of your money because they need that money to cover the bets that they've made in leveraged short selling positions. So there's examples of bail-ins that have occurred around the world in the past, Greece being a most notable example. And so these bail-ins, we could actually see those in 2026, bank bail-ins. If you are watching this at home, please don't get alarmed, don't be concerned, but have some level of caution throughout your day-to-day in terms of the economy. What I will be doing and what I would offer as an idea for those of you watching along is maybe consider holding some physical cash. I'm not talking about going to the ATM, withdrawing tens or hundreds of thousands or anything like that. It may be a smart idea in 2026 to hold some physical cash in small denominations in your house, just in case something were to happen with our global banking institution whereby funds became inaccessible for a day, a week, a month. Probably low risk or low percentage, but that's what I'm doing. It may be something that you may want to consider as well. But that is the reason, that is the current situation around silver globally. I think because of the vast and vicious demand for silver, not only in commercial use, but also in retail use, because of people trying to hedge their bet against currencies. Not only that, but China as well, restricting exports of silver as they are one of the largest holders globally of silver. I think we will continue to see silver increase in price. I can't give you a value specifically. I can't give you a dollar figure specifically of where I think silver will go to, but I don't think it's turning around anytime soon. I don't think silver is in a bubble. I think it's in price actualization, which is a real and supportive metric of the price of that asset. And so I think we'll continue to see that through 2026. Probably gold as well, but I don't think to the degree that we will see silver climb. That's been outlining silver and what's going on in that current market. I've been James, and this is Money Media. Any questions, comments, leave them down below in this video, and I'll see you for the next one.